Now, when we turn to Europe, it's important to appreciate, the annual inflation rates, where they sit right now, and then what are they going to look like going forward. So when we look at the EU for November, you can see it was at 5.2%. Germany's at 6%. You have Spain at 5.5%. You have a lot of the big countries really seeing some of this massive increase. And these are some of the fears that we have when we look at, well, what are input prices going to look like? What are raw material prices going to look like? And how is that going to shake out going forward? So when you look at the euro area, it's a little bit better, about 4.9%. But when we consider where a large part of the economies sit and where the economic growth is really weighted towards that high level of inflation, which is where, when you then factor in, well, where are things going to go in the future, and you start looking at PPIs and all of these pieces, there's a lot of this inflationary push. And just picking on Germany for a minute, because they're such a big exporting nation, that means that they're going to try to increase their export prices and cover some of this elevated pricing. So then when you look at the industrial production side on the euro area level, the industrial production is getting better. When you look at the EU in general, it's getting closer to that pre-pandemic level. But at what price will people start to balk? And I think that's going to be the biggest hindrance to getting some of this production back to normal, as to who is going to eat the higher price. And that's when we start looking at import prices into the US and some of these underlying pressure points that will keep inflation essentially sticky as we go through on a global level around the world in 2022. And then the industrial production, when you look at just what is driving it, a lot of the heavyweights of the economic growth are actually to the left side of the chart this time. When you look at Germany, Spain, France, Italy, and a lot of the smaller economies are at the higher end, again skewing things a bit in terms of just where the growth. Again, a lot of it's still growth or just slight declines, but there will be some of this hindrance as we go through the remainder of the year. As we go into 2022. So then when we look at the Eurozone Aggregate, CPI coming in right in line with expectations, obviously elevated. Construction output rose in October, as we discussed, but has actually fallen in November. But consumer confidence is the one that came in light. It was expected at 8.3%, 8.3 decline, came in at 8.3, but previously was at 6.8. So you're just not seeing people get confident. Obviously, it's the issues in terms of inflation, jobs, coronavirus. There's a litany of things that are creating some of this overhang that we continue to see in the Eurozone. Now, household gross disposable income as a percentage changed since Q2 of 19. It's gotten a bit better in Germany and France, declined in Italy, but Spain is the one that keeps cropping up as the biggest problem. And the reason why that is a bigger issue overall is because Spain also has the most exposure to Turkey. So when you think about some problem areas to watch, Spain continues to come up as a big red flag that could have some broader exposures. And then when you look at the amount of inflation, PPI is at a record of 33%. You look at just the lack of disposable income, inflation ripping higher. Oh, and their debt is still negative. And it's like there's just so many disconnects in the risk profiles, harking back to what we talked about in segment 1. And Spain, I think, is the poster child of that. So then when you look at the ECB monthly net asset purchases as things progress, the PEPP, or the Pandemic Emergency Purchase Program, that'll continue to peter out, and it'll end by essentially about March, April of 2022. And then the asset purchase program and the APP will continue to step down and reach its lowest point by Q3 of next year. And some of this was pulled forward, obviously, because of these inflationary pressures, which has caused the ECB to be a bit more aggressive on the tightening side. And then when you look at the net EGB supply, excluding bills, and the ECB net purchase, you get an idea of where that shift is expected in 2022. and just what really drove that increase this year with the PEPP. And as that drops off and dries up, you'll see a faster, bigger acceleration down, which I think is really the bigger goal as inflation really starts to take off. And at the same time, again, leading back to import prices, export prices, the Eurozone trade surplus is melting away, surprising to the downside, and it's partially due to weak demand from China and lower vehicle sales. Now, the vehicle side is getting better. It's kind of flatlined and will start to rally. But the bigger issue remains just China not importing and China being as sluggish as it is because Europe relies the most on China right now. So the Eurozone construction output, bouncing to 110.5. So you're still in a comfortable range in October. It slowed down a touch in November, but again, still remaining. And by slow down, the automobile side has gotten better in November, but other forms of construction has gotten a bit worse. So that'll kind of balance out some of those different pieces, but it'll be a net negative from where we are, but still a fairly stable number. Then when you look at manufacturing, construction services, this is kind of gives you the backdrop as the percent of value. Added sector, in terms of just the severe shortages, and those labor shortages are everywhere, and they're only getting worse in Europe, which is creating these additional pressure points. The U.S., we've seen it, and now you're seeing it here, which is going to increase wages, which is going to increase price, which is again going, like if you think about where Europe is versus the U.S. on an inflation standpoint, they're very much behind us, and that's why I think you're going to see, as the U.S. starts to slow, you're going to see a bigger acceleration of inflation in Europe. French PPI month over month, last month was 2.9%, came in at 3.5%. Year over year was expected at 14.9%, came in at 17.4%. Big acceleration to the upside. Again, you're just seeing these prices. Then when you look at PPI in Spain, with the month over month, last month was 6.1%, came in at 1.8%. So the pace slowed, but year over year was revised to 32%, came in at 33.1%. French PPI at all-time highs, month over month, year over year. Spain, year over year, all-time high. Again, these are the pressure points that we continue to see as a leading indicator of where these prices are going to go. Same thing played out in Germany. The expectation, it just came down a touch. The expectation was for 1.4%, came in at 0.8. Year over year was expected at 20%, came in at 19.2%. Still well over the previous month, but you're seeing, again, those pressure points as we remain, especially for an exporting nation. IFO expectations was expected at 93.6, came in at 92.6. Current assessment was expected at 97.5, came in at 96.9. Business climate was expected at 95.3, came in at 94.7, all of which are negative. Bringing consumer confidence was expected at negative 2.7, came in at negative 6.8. So Germany's very concerned. A lot of slowdown, being calculated, and again, we've been talking about and highlighting the growth problems there, and it continues to play out. Then when we turn to Italy, Italy PPI last month was 25.3, came in at 27.1. Month over month was expected at 9.4%, came in at 1.3%. So you're still seeing everybody across the board seeing the step up in underlying prices, and that is leading for the German side when we look at business climate, business situation, expectations. All of business expectations have all turned firmly negative outside of manufacturing, which is stabilized. But that's more due to a recovery in cars, where when you look at service sector, going negative, trade going negative, construction negative. So it's really the manufacturing and the car side that is getting better, while the other pieces of their economy continue to soften. And then when we look at business expectation, this puts it into a graphical form on just how low it has gotten and the problems on how people view the future. And then just rounding this out in terms of the Bank of England, and I know we don't talk about the Bank of England as much, but there's where you can see that the slight increase, it was a bit of a surprise. Again, we've been saying from the beginning we're in a rate rising cycle. People have argued that we're not, and here's just another example of that surprise increase. Still low, it's only at 25 basis points. So, and it was only an increase of 15 basis points, but it's just showing how that creep is really starting and will accelerate. And now this is something that we're going to pick up with when we start the next segment. But European exports to China remain depressed, and then the China annual adjusted change in total social financing. Europe is continuing to see that drag, and it's not getting any better. It stopped going down, but we're not really seeing any type of recovery, which is going to be that broader overhang that we've discussed on European growth, especially Germany at this point. So that's what we have to close out the year for Europe. And now in the next segment, we're going to go deeper into China and what are some of the things that are going to happen on the PBOC and their easing monetary and fiscal schedules.